the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to yet another episode of the Business Standard Banking Show, where we bring you the story behind the latest developments in the banking world. Today is the 24th of August and I am Ruchika Chitravanshi. In today's episode, our cover story will talk about whether the RBI is in a better position to support the rupee. In Banker's View, we have with us this week Saurabh Tripathi, Managing Director and Senior Partner, Boston Consulting Group. Our Banking for You segment today will tell you all about the Senior Citizen Savings Scheme. In the Expert Take segment, our consulting editor, Tamal Bandhopadhyay, will speak to us about how long will this good run of banks last. At the end of the show, we will tell you the results of the last week's poll and the question for this week. One of the big responsibilities of the Reserve Bank of India is to defend the Indian currency. The Indian rupee had dropped recently on the back of broadly higher US dollar. But thanks to RBI intervention, losses were kept in check. With renewed pressure on the Indian currency, is the RBI in a better position to support the rupee? Manojit Saha explores in our cover story.
After depreciating around 10% against the dollar in 2022, the rupee was remarkably stable in the first half of 2023. It had appreciated 0.5% till June. What were the main reasons for the rupee's weakness last year? The first was the war in Europe, and the second was the interest rate hikes by central banks in advanced economies like the US Fed. The Reserve Bank of India, or RBI, intensified its intervention in the foreign exchange market in 2022. This intervention resulted in India's foreign exchange reserves falling to $524 billion in October 2022, from an all-time high of $642 billion in September 2021. On the back of healthy foreign fund inflows, the central bank changed the trajectory of reserves in 2023, as reserves went above the $600 billion mark again. The hawkish stance of the US Fed, along with the weakening Chinese currency, the renminbi, is now putting pressure on the rupee again. On August 17, the rupee hit an all-time low after it closed at 83.15 against the dollar. The 83 per dollar mark was breached after 10 months, as the RBI protected such levels. Now that the Indian currency has come under renewed pressure, will the RBI be able to guard the currency?
Reserve Bank of India has been buying dollars when rupee went to 81.70 and have brought their reserves amount to nearly $600 billion, as you would be noting. And I think the amount of dollars with Reserve Bank of India are sufficient for Reserve Bank of India to keep a guard on the rupee. So, though they will surely not allow the currency to weaken in a big way as it happened in 2022, but as you can see from other currencies, that particularly the yuan, which I wanted to elaborate a bit here, that the differential between yuan and US dollar interest rate differential has been going up considerably, and that's the reason why yuan has been weakening in the last few days.
The Indian rupee, which has depreciated 1.1% against the dollar so far in August, is expected to decline further on the back of a strengthening US dollar and a weakening renminbi, according to a Business Standard poll. Most participants said the rupee could test the 83.5 per dollar level. RBI Governor Shaktikanta Das exuded confidence in protecting the rupee when he said, "With $600 billion in reserves, I think we are in a far better place today to deal with any situation." RBI always maintains that the central bank deploys foreign exchange reserves to contain volatility in the currency market.
Yes, RBI is in a better position to support any sharp depreciation or any sharp weakness in the rupee. I think in last 1 year or 2 years, RBI have done a fantastic job in managing the currency very, very well. That is why it was in a range. Even if dollar index or 10-year yield moves higher, we are not expecting rupee to move beyond 83.30 to 83.50 kind of level. And gradually we expect that the pair should move towards 82.50, 82 and 81.50 kind of a level in next 6 months. So the broader range for rupee is 81.5 on the lower side, 83.30, 83.50 on the higher side.
Most of the participants in the BS poll also said the local currency would regain ground against the greenback by the end of the current calendar year on the expectation that the US Treasury bond yield and the dollar index might have topped out and could start moderating.
RBI Governor Shaktikanta Das is confident that we are in a far better place today to deal with any situation. In an exclusive interview with Business Standard's Raghu Mohan, Managing Director and Senior Partner at Boston Consulting Group, Saurabh Tripathi shares why the ongoing funding winter is an opportunity for Indian fintechs to revisit their business models while they still have a hold over legacy institutions.
Welcome to the BS Banking Show, Saurabh. Good to have you here.
Thank you very much, Raghu.
What in your view will be the fallout of the current funding winter on fintechs?
Well, I think the current funding winter in fintechs is in some sense a good thing. I know there's a short-term pain, but I think it is forcing the industry, the entire fintech industry, to think hard about business models and paths to profitability. And I say paths to profitability because I think the investors are starting to look for clear path to profitability, not necessarily that you have to make money immediately, but those business models which were sustained by extremely low interest rates and hence very cheap money, they cannot sustain. And I think in some sense, it's a good thing.
Now, for some time, it has been suggested that fintechs are playing off regulatory arbitrage. With that window getting closed, how serious will be a look on business models themselves? And if it requires going back to the drawing board, will many fall by the wayside?
Some have already fallen by the wayside, and some have changed their business models. But then this is not as big a deal in the fintech world. That is part of life, where this is the part of the banking sector which believes in fail fast, right? Yeah, some things will fail, some things will not work out, some unexpected changes will happen, and the fintech business models are agile to be able to deal with pivoting their business models. Right? That's the whole idea behind the growth tech, this type of entrepreneurial venture. So it sounds pretty dramatic, but it is a part of life in this space. So some of them have had to adjust, and I would not say that they were playing on regulatory arbitrage. I think they were just spotting an opportunity and trying to create a business model around it. Some of those opportunities have been sort of modified by regulatory action, and new fintechs will emerge, new issues they will go after. I am very hopeful that the level of entrepreneurial energy in the sector is only going to go up in the next few years.
In which fintech areas do you see this change happening in a big way? Will it be payments, lending?
No, I think the biggest area where the Reserve Bank in India has come out a little bit strongly in terms of new regulatory provisions is on the lending side, especially on areas where fintechs were a lot of fintechs were involved in lending activities which were not kosher, or there was a relationship between non-regulated entities and regulated entities, and that relationship had to be clarified. The customer needed to know exactly what is going on for the sake of clarity. So some of these things are basic housekeeping which have been done. But lending in India has huge appetite for credit, and I don't see that coming down at all. For last 10 years, it has been like that. On consumer and business banking side, there is still a huge untapped potential, which I think banks are wanting to go after, but banks have only so much of capacity. So we will continue to see tremendous growth on the lending side with new different business models. Payments as well is nowhere finished in terms of its. But we will also see things like embedded finance, coming up. We also expect new business models around B2B, on SME business models. There is another sector that we are very excited about, which is fintechs which do not compete with banks, but actually will support the banks become better. That what we call financial infratechs. And that sector also, we believe, is going to be very strong sector. One last sector I'm very excited about is software as a service solution providers. And I believe that many of the Indian fintechs are not only going to serve the Indian banks, but banks globally. So there is so much excitement ahead of us.
Do fintech still have a hold over legacy institution when it comes to response times or approach to business? As in, has not the gap narrowed?
Not at all. The gap has not narrowed, and it is unlikely to get narrowed anytime soon, because the gap. It is very difficult to just throw money to fill that gap. That gap is organizational. That gap is not about technology. But technology also plays a big role. Obviously, most of the fintechs have completely fresh technology stack, which is digital native. So it is quite versatile. But more important than that, fintechs are able to create an environment which attracts very high quality talent, right? Because value creation opportunities there. And also a work environment which attracts the good talent to work together in small teams and with a lot of ownership. I think many banks are trying, but it is a very big and very difficult job to create that type of work environment in a legacy setup. And I mean, obviously, banks are experimenting with many different models. Some are trying to do things internally, some are trying to keep it in arm's length, and some are trying to buy out fintechs. But it is not an easy problem. It is so we are not going to see the gap bridged anytime soon.
And lastly, are we on the cusp of consolidation in the fintech sector?
So I think consolidation is a term that I think is used in those industries which are more mature. Like this fintech is a 25-year trend, and we are in the third or fourth year. It is a high growth thing. It will grow very, very significantly. I think what we will see here is that it is a rationalization phase, I would say, not consolidation, where certain business models which are not sustainable, will be churned and others will become bigger. But we believe new ideas are going to come, new things are going to come in next 3 years, and new types of fintech will come. So it is not that just a few will become bigger by absorbing others. I think the level of innovation that is ahead of us is significant, and it will be a different type of industry evolution than what we would traditionally call consolidation.
Saurav, it was wonderful having you on the BS Banking Show. We look forward to having you once again. Have a good day.
Thank you very much, Raghu. It was a pleasure.
The Senior Citizen Savings Scheme is a government scheme to help senior citizens ensure a regular flow of income post-retirement. Raghav Agarwal gets us all the details about this fixed income investment options for those over 60 in our Banking for You segment.
Introduced in 2004, Senior Citizen Savings Scheme is a government-backed savings instrument for people above the age of 60 years. It is aimed at giving senior citizens access to steady and secure income after their retirement. Under the scheme, individuals can regularly deposit money in their accounts and are then given quarterly interest by the government. As it is government-backed, the risk involved is very low. To avail the Senior Citizen Savings Scheme, accounts need to be opened at a post office or an authorized bank. An individual of 60 years or above on the date of opening an account is eligible to be a part of the scheme. Also, an individual who is 55 years or more but less than 60 years and has retired under the Superannuation, Voluntary Retirement Scheme or Special VRS can open an account. Moreover, retired personnel of defense services, excluding civil defense employees, may open an account upon attaining the age of 50 years, subject to the fulfillment of other specified conditions. Account holders can choose to open individual or joint accounts with their spouse. Under the scheme, an individual can make a minimum deposit of 1,000 rupees in the multiples thereof. The maximum limit for deposit has been pegged at 30 lakh rupees or the amount received on retirement, whichever is lower. Earlier, the limit was 15 lakh rupees, but it was doubled in the budget 2023. If an individual holds multiple accounts under this scheme, the total amount deposited in all such accounts should not exceed the maximum limit. The maturity period is 5 years. It can be extended for another 3 years, taking the total effective period to 8 years. The interest paid during the first 5 years will be the one which was at the starting date. If one opts for an extension, the interest rate applicable at that quarter would apply. For example, an individual deposited 7 lakh rupees under the scheme in April 2018, when the interest rate offered was 8.7%. However, when they extended the scheme in April 2023, the interest rate they were eligible to earn was 8.2%. It must be remembered that the interest received is subject to taxation as per the applicable slab of the taxpayer. And if the interest income in a year exceeds Rs 50,000, it is subjected to tax deducted at source. The scheme allows premature closure of accounts. However, some amount is deducted as a penalty. If the account is closed before the completion of 2 years, 1.5% of the deposited amount will be deducted as a penalty. If the closure takes place after the completion of 2 years, 1% of the deposited amount is levied as a penalty. Extended accounts can be closed after the first year without any penalty. The depositors are eligible to get a tax deduction of up to 1,50,000 rupees under Section 80C of the Income Tax Act.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
As Raghav said, since it is government-backed, the risk involved in this scheme is very low. And we know senior citizens would not like it any other way. Moving on to our expert take segment. Our consulting editor, Tamal Bandhopadhyay, talks to us about how long will the good run of banks last and some of the other happenings in the banking space.
Hi Tamal, welcome to the Banking Show. We're talking first of all about the column this week where you've talked about the good run of the banks, but you've raised a question, how long will it last? So first of all, how long do you think this is going to last and what are some of the big challenges going forward?
Oh, well, I wish I knew this. In fact, for the last few quarters, particularly the last quarter, which is quarter ending March in the fiscal year 2023, I thought that, well, we have seen the best, and from now on, it would the good run. There'll be difficult, there'll be challenges, but a good surprise. The latest quarter, June quarter also, is yet another quarter where the banking sector has done better than the previous quarter. How long it will last is difficult to say. Probably we'll see through this year, because the concerns are, while the NII, that is net interest income, is pretty healthy, which is the backbone of banking operations, the income of banking operations. But there are concerns. One concern is the NIM, net interest margin. Has now started compressing for the most of the banks. What does it mean? That means their cost of fund is going up. Whether their ability to charge higher interest rate is restrained. Of course, there's a one-off incident like Reserve Bank of India has raised the CRR on a temporary basis. Following that, some of the banks have raised their interest rates. But overall, we presume, barring unforeseen circumstances, we have seen the highest level of interest rate. And from here, of course, it will stay here for quite some time and then it will go down. So banks' ability to raise interest rates, the lending rate is not that high, but their banks' cost of money is going up. How does it going up? You see that CASA, which is a low-cost current and saving account, for the most bank has gone down, which means the depositors are shifting money from CASA to fixed deposit to earn more. And of course, they are also shifting to mutual fund. That's a separate story. And other factor is this: while lending rate, the moment you charge, you raise your loan rates, it's just effective immediately. but the deposit rates can take effect only, higher deposit rates can affect only at the end of the current maturity of the deposits. So as more and more deposits get repriced, banks' cost also goes up.
And do you see the story is similarly playing out for both public and private sector banks, or do you see some differences?
Well, if you see, this is a very interesting question. Public sector banks' profits are higher in terms of growth. I'm talking about growth. At the back of public sector banks, profitability, profit growth is higher than the private banks. Public sector banks, both net as well as operating profit going up. When it comes to NII, that is the net interest income, both are on a sort of even place. I mean, both of them almost the same, similar. I'm just talking about both, not in absolute number. But we must remember that when it comes to provision, public sector banks actually doing far less provision than private banks. Actually, this quarter public sector provision has gone down. Private bank still up, but little less. Overall, public sector banks NPA, both gross and net for many banks are higher than most private banks. So it's difficult to say, but the fresh slippages I understand is both. It's true about both sets of banks, and the shrinkage in NIM and CASA are both true of both sets of banks. So I don't think there is much to distinguish between, because typically public sector banks are less savvy when it comes to risk management, underwriting, etc. But I think in the past, after Reserve Bank of India's special audit, that AQR, they have become wiser, and so there is nothing much to distinguish between. Of course, there are banks and there are banks. Among the public sectors, some of them will be pretty strong. Similarly, among the private sector, again, many of them pretty strong.
On August 17th, the rupee hit an all-time low after it closed at around 83.15 against the dollar. Now, the currency has come under some pressure. What do you think are the implications of this?
Well, implication is this. You see, the dollar index is gaining strength of late, and it started with Chinese currency going down, and rupee has been faring better than all the other Asian currencies. So that's the background. Yes, rupee has slipped beyond 83. Will it come back to 82 and 82 plus, etc.? I don't know. That's a matter of, we need to watch out for. But we need not be unduly concerned about this. I understand, I cannot vouch for it. Reserve Bank of India is selling dollar because Reserve Bank of India's forex kitty is pretty handsome, not an issue at all. So we can manage that. Probably rupee will find a new level, which is lower than the previous level. But we would not be undue worried. But the implication, if you ask me, the combination of currency, what's happening in currency, and if rupee goes down further, and the high inflation, what we have seen, pressure will be on RBI and the MPC on the rate side, because what Reserve Bank of India has been saying that, well, the inflation is temporary, and we are keeping a very close watch. We are ready to do everything as and when it's required. And there are not the rate alone, there are multiple instruments in the custody of Reserve Bank of India. One of them is that very temporary CRR that they raised. But if rupee keeps on slipping, which it will not, and a high inflation, that will put pressure.
There is a drop in a net interest margin of banks, which is of concern. And as you said, there will be implications of the fall if rupee and RBI will face some pressures. We will see what the monetary policy holds for us next. And of course, we will discuss that with you when that happens. Thank you so much, Tamal, for joining us today. So nice to chat with you. See you next week.
Banks' operating profit has not grown in sync with the net profit. As Tamal pointed out, there are a string of challenges that banks have to watch out for going forward. And now to our poll results. Here's what we asked you last week. Should smaller UPI payments not need a PIN?
38% of our respondents said yes, while 62% felt no.
This week's poll question comes at the back of the high inflation number of July. The retail inflation, which is measured by the Consumer Price Index, rose to a 15-month high of 7.44% in July 2023. Now, to control this, what action do you think RBI can take? So here's our poll question for this week. Should RBI pivot to a rate hike? Our poll is open from today, that is Thursday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. That's all we have for you today. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.